Hello and welcome. I'm Erik Brenner, President of Hilltop Wealth and Tax Solutions, and thanks for joining us today on this live market update. And I think it's timed quite well. Obviously, there's a lot going on right now, and we're going to try to cover it and give you some insight and hopefully help you think about things. So with me today, I have Matt Aurenz. Matt, thanks for joining us. Matt's a wealth advisor and is here to kind of comment along the way. A couple things I want to set the stage. We are going to record this, so if you want to go back and watch it again or watch pieces of it, you certainly can do so. You can catch it on YouTube, you can catch it off of our website, and if you're watching this on Facebook, and if you haven't liked us on Facebook, if you could do that, that would be extremely helpful as well. The other thing is that if you have questions and you want to send them in, you can send them to Betsy, and on the screen there is the email that you'll send them. I have my computer ready and waiting, and I know we've got some questions already that we're going to cover, but if you want to send in a question for Matt and I to answer, we'll try to get to them as well. We really don't have a set time. We're going to work through our information that we've prepared for you, and so we'll get through it when we get through it. So we got a lot of information to cover, so let's go ahead and jump in. Matt, you know, when we look at the results, so I just wanted to kind of, for our audience here, kind of get to the results. The S&P 500 year to date is down 8.22%. Interesting thing about that, and it's easy to forget that 2021, the S&P 500 was at 28%. So, and then in 2020 was at 8%. The Dow's down 7%. The Nasdaq's down 13%. The international market, the EFA is down 9.65. So, you know, from a market perspective, we're, you know, potentially in that 10% number, right? Right. Which is, you know, considered, you know, are we in a bear market? And then inflation. So I know we're going to talk about this, but I wanted to bring this up for the audience that in 2019, the inflation number was 2.39%. And, you know, as of 2022, it's 7.48. So I know we're going to talk about inflation because, you know, we've been talking about this for a while, that's an issue there. So there's a lot going on. You know, we certainly here, the entire Hilltop team sends our thoughts and prayers out to the Ukrainian folks. A lot going on there. And so we want to talk about that. We want to talk about higher inflation. We also want to talk about, you know, moving forward in 2022 and how folks should be thinking about it. And we really want to not have emotion in it, right? Right. We really want to not have emotion. So we're going to talk and remind people, if you are clients, about our investment management process and kind of how we go about it, and then our communication plan, you know, going forward for those clients. So let's jump in. So let's talk about performance year to date. We are down a bit. You know, kind of how are we thinking about it? I know we just had our investment committee meeting on Tuesday, so this is kind of fresh from our thought process and our partners, you know, how they're thinking about it.
Yeah, well, and let's not forget, Erik, that even the general aggregate bond market's down about 2.5% this year. So there are tons of pressures right now, both in the equity space and in the fixed income space, that you know, are creating some frustrations for a lot of people. And right now, I think most of that really is just stemming from the Fed and what their expectations are in raising rates. Mm-hmm. So the market's trying to reprice some of that in when it comes to the equity markets, and obviously the fixed income market will have constant headwinds as the Fed raises rates because of that inverse relationship. So those are just things that we're trying to navigate. What are the current Russia-Ukraine influences in that? You know, right now it's really not too much. It's headline news, but those aren't really the things that are creating the downward pressure when it comes to equity and fixed income. Again, that's really much more Fed and government policy related. So it's a touchy situation. And the news and what's going on there changes rapidly, so the market is obviously adjusting accordingly.
Yeah, I mean, it is kind of this daily or even hourly right now, right? So, and you know, to be clear, we expect some volatility. Correct. You know, there's going to be volatility. There's days where someone sees the market, it's going to be up, there's going to be down. So we certainly expect that. And I think a good reminder is where we're at. So, the Dow, I mean, it can be down 500 points, 400 or 500 points, but it's 1.6%.
Correct.
So we've really grown both in the Dow and the S&P and really all the markets. So, the shifts sound like 400 or 500 points, right? For us 10 years ago would have been a big number.
Huge number.
And now it's not quite as big. So I think that's a part of it. So really market pressure, investment pressure, certainly Ukraine, right? And then what's our, let's talk about what a couple other keys that we're watching.
I mean, I think a big one that we're watching is obviously inflation. That's a major one I think most people are experiencing right now. And when you take a look at inflation, it seems to be the things that hit people the most, which would be, your grocery store, empty shelves, or it would be the gas pump. Those are really the two biggest things that most people are experiencing. Then you have some others, which would be the housing market, commodity prices, and you would also run into things like automobiles. But a lot of those things are just supply chain issues, which are creating inflationary expenses that people just kind of aren't accustomed to. If we look over the last several years, you're talking 1 to 2%. In most years for about the last 10 to 15 years. You'll have some anomalies here or there. So when you look at inflationary expenses, it's kind of just been non-existent for the last 10 years. So the second you get some inflation, it hurts, and it hurts pretty quick.
And I think it came on quicker than really what the Fed, which I know we're going to talk a little bit more about that, but then really what they expected.
Correct.
Right? I mean, it just came on because we said back in 19 is 1.3%, which was really unheard of. So that's interesting. So I want to talk about and pull up here the first graphic that we have and talk about the Fed. And there's a lot of data obviously that we get, and if you're looking at this, how the markets are thinking about a rate hike.
Sure.
So why don't you go over this graphic for us?
Sure. This is just kind of giving us some expectations of the Fed policy saying, hey, it's time to move rates up from 0%. 0% is really just saying we're in crisis mode. And, Jerome Powell even came out yesterday and said we probably should have made moves to increase this Fed rate earlier than we did. We've left it in crisis mode for too long, and we haven't been there. And, we haven't seen, traditionally the Fed increases rates by about 0.25% at a time. We haven't seen what they would refer to as a double whammy since 2000. So this is just really the expectation to say, what are the rate increases going to be? When is the likelihood that they would go up? It does create a little shock wave in the market if you go more than 0.25%. Jerome Powell just said the other day, with the Ukraine-Russian things going on, likely won't increase rates as fast as otherwise would have. That was some positive news for the market, so we saw a little bump in the market on that day. But we're saying there's about a 90% likelihood that we'll see the rates increase in March here at about 0.25%. And, the Fed was talking about 3 rate increases this year. And so this slide just kind of gives us the probability of when those would occur. And when those ranges are, and you can see they do have a relatively aggressive rate increase on their agenda, which would say over the next 3 meetings that we would see going from 0 to about 75 basis points in a short few months here.
Yeah, and I know we were initially a bit concerned about they were going to try to bite off too much of the apple, right?
Correct.
Then that just doesn't seem to be the case.
It doesn't seem likely.
Now, with the market pricing, though, the 5 to 6, I mean, especially this is an election year, so I mean, we're thinking more 2 to 3, but a little bit unknown there for sure.
Correct. Yeah, and let's be realistic. It just seems like there's always politics involved in all of this, and so midterm elections are going to play into this. So it'll be interesting to see.
It's interesting with this, and we get a lot of questions around, okay, how's that change my CDs and stuff, and it takes a while for that to get. I mean, it's not going to get through the market, and what's going to be really, really important going forward, even more so, when you get a 7% inflationary number. Now, 7% may not affect everybody equally.
Correct.
But they're feeling it at the pumps.
Correct.
And I know we're seeing more and more clients starting to schedule travel and all of that. They're going to feel it there. So it's going to be more and more important to, not sit on money that's not earning money, because it's not even going to keep up with inflation.
Right. I mean, if you took it just simple terms, like you just said, if you're getting 0.01% in your savings account,
Yeah.
and inflation goes up, let's call it 7, your actual return for the year, the buying power, your purchasing power of that money next year is negative 0.699%. That's a real number that hurts pocketbooks. So you have to combat that somehow.
Add taxes on that.
Correct.
And, it goes the other way.
Right.
So we think that's one, as it relates to the inflation number. Certainly it is reality. And as you said earlier, they probably waited too long. That's always a tough call.
Correct.
But they probably waited a bit too long. So let's look at the next graphic we have. This is one that we have shared on and off over the last few months. We think it's a great, it just lays out, they do a poll of economists and kind of where they think inflation's going to be. And so, we got kind of the medium, get some that think it's going to be higher, but it is a bit encouraging. At least it doesn't show it straight line across.
Right. And I think everybody has this understanding that inflation right now is much more due to, coming out of the pandemic and supply and demand, and the ability, with the supply chain having a lot of struggles over the last couple of years. Again, go to the grocery store, the shelves are empty. You go to buy an automobile, the lots are empty. So the supply chain hiccup right now has put a huge demand for the goods that are remaining, which obviously just boosts prices up. So as those begin to normalize, the expectation that most economists are seeing is you would see inflation decrease relatively quick to get back to normal rates of that 2, 3, 4% era.
Yeah. That's a good comment. So as a reminder, you can send your questions to Betsy. It is on the screen there, and we'd be glad to take your questions. And I've got a question around, I think that's appropriate to talk about. So with the recent sanctions that have been put on Russia on the supply chain, I mean, you mentioned it a little bit, Matt, but, how's it, in general, how do we see that going to be affected? I know Russia, as an overall economy is globally is a pretty small amount. Certainly oil is one of them. So how are we seeing that?
Yeah, I think you just said it there. Really Russia's economy when it comes to world GDP is almost obsolete.
Yeah.
Aside from energy, there's really not much. The U.S. has about a 20% dependency on Russian oil. They're talking that would go away, that we would stop that. We'll see if that holds true. But the European region requires a lot of oil and energy from there. So those are going to be a hiccup. They're not going to necessarily hurt right away. So when you're talking to your Russian economy, it's not really going to influence. When you begin to look at ripple effects, it will be interesting to see how that energy in the EU in particular combats the supply chain issues. But you're also seeing sanctions to no longer allow Russian ships to port, those types of things. But again, when you're looking at exports out of Russia, really not a ton aside from energy. Now, the U.S., we saw the stat the other day, it's about 80 to 90% of our farming agriculture fertilizer comes from Russia. So that'll be interesting to see how that develops come planting and farming season. But I'm sure that the U.S. is very well aware of that, and we're going to figure out how to
try to figure out. There's going to be higher prices, but
Correct.
That's kind of where it's at. We were talking, setting the stage of reality and kind of where the S&P 500 is today, and really where it was October of last year. So why don't you comment
so
on that?
October of last year, it was a price right around 4,300. And today it's priced right around 4,300. So, a lot of questions that we get are really, we're in this free fall. And actually, that's not really the case. Fourth quarter earnings have come out. They've had some of the best earnings seasons that we've had in a long time. Fourth quarter of last year, GDP growth was well above economists' expectations. And so what we're seeing is, low unemployment numbers. And consumers looking to spend has really been encouraging as these earnings come out here in this first quarter. And so that is helping keep pressure against the Fed rate and monetary policy movements. But really, we're kind of within this range. It's not like we're seeing a huge decline. We're just seeing some bouncing around. We had some growth late fourth quarter. We've lost most of that. It's just bouncing around. So I don't think that we're going to see really much more of a steep decline by any stretch. You're just going to have days where we see a nice 2 or 3% return, and the next day we're not, until things begin to sort themselves out.
Yeah, that's a great point. And you know, I think that you know, 08, 09 particularly, when we went through that, and certainly, you know, was huge market declines and companies getting bailouts and stuff. You know, that in one way, that from a large company perspective, it really changed the way those leaders run their companies.
Correct.
You know, and so, and profitability, right? Profitability of those companies that are publicly traded, that's really critical in the stock market. Right. And our price earnings, the PE ratios, we're not overpriced.
No, we're not. We're not. You know, we're low 20s, which again just says that there's plenty of room to grow.
Yeah.
And sometimes people say, well, that looks higher than normal, but the S&P, you know, it's really evolved over the last 10 years with technology being a huge portion of that index. So again, it's a very fair pricing at this point. Earnings are justifying that pricing, which actually says we still have room to grow. We're quite optimistic for the remainder of this year as we navigate these waters.
Yeah, just get through the volatility.
Correct.
So with that, I want to shift a little bit on, you know, that's the economy and markets and kind of the outlook at this point. But we don't really know the future.
Correct.
You don't know the future,
I
right?
wish I did.
So we don't have the crystal ball.
Right.
So, you know, we base, as clients know, and we just want to kind of reiterate and talk through really our investment process and how we go about it. And so, you know, it's really important, especially when we get into volatile times, that we pay attention to the data, right? It's not a feeling, right. It's not emotion. We pay attention to the data. And so, you know, what the data, and we look at this, right, twice a month, but where's the data at? You know, kind of where are we at? We've made some adjustments, but let's talk about that.
Yeah, for us, I think the data at this point is saying, hey, earnings look good. Mm-hmm. There's a reason to own what we need to own. We've definitely taken this overweight position to U.S. equities right now because we favor them more. And I think everybody can understand the rationale there. And then when it comes to fixed income, we're saying, hey, the Fed's going to raise rates. So again, that inverse relationship that says as rates go up, bond prices will go down. How do you combat that? We've taken a drastic shift to say, let's move to shorter duration, things that are not going to be influenced by interest rates. So we've repositioned the bonds. In the equity space, again, moving more to domestic equities, upsizing our capitalization and saying we're going to stay with more large cap opportunities. And we'll own a few sectors where we think that they're appropriate. And we've taken a little risk off the table during this volatile time. You know, over the last couple of months, we've just slowly backed down some risk, waiting for opportunity to, again, re-engage to an overweight in equity exposure.
Yeah. So when we think about kind of our investment process, one of the things we talk about a lot is, you know, we start with, okay, how do the big guys do it? You know, so these large pension funds and insurance funds, and you know, that have $5-10 billion in it, and you know, what is their process? And even 10 years ago, we could have not brought that process into our clients' models.
Correct.
So, you know, and they just don't, the insurance company doesn't turn loose the investment team and say, take $10 billion and invest on a hunch.
Right.
You know, or a guess. You know, their core strategy is based on quantitative, which is called data research. And, you know, we've partnered with this firm, Helios. We talk about it a lot with clients. So if you're a client, you've probably heard it. But, you know, they really provide data. And that's what we said. It's really important in this time that we're in, that we do data. So let's talk about, and I'm going to pull on the screen here some of the key takeaways that we want people to get. You know, one is it's factual data, right, Matt? It's not forecasting, you know. And in fact, one of the questions was, should I get more conservative because I'm now in retirement? And so it addresses this. And remember, tie it in, should you get more conservative, but we got 7.5% inflation.
Right. Right. I would say, the data is saying what's the equity exposure that you need to own based on your risk tolerance. And we usually have about a 30% ratio of variance that we have, the ability within portfolios for your target risk to say we can own more or we can own less, but we're managing that. You don't ever want to just get out, especially in high inflationary periods. The best way to combat inflation is by owning equities, because they're going to pass those costs down to consumers and maintain profit margins. That's why you own stock.
Yeah.
But the reality says there are periods where you need to own more or you need to own less. And so that data from that data-driven approach says now's the time to own this on a risk-adjusted return based on these expectations and rationale from, again, the data. So it's not a feel-good story of, well, I'm feeling this or I think this. Again, to your point, it's the math says this. We have to rely on what the actual data is saying and position the portfolio appropriately.
Yeah. I mean, that's a great, and again, I know advisors have these conversations ongoing every week with clients. We get a lot of people, watching this that are not clients. And so, how's that all calculated is really important. It is an active managed portfolio, meaning that you just don't set it up with a risk tolerance and not change it for 2 years, 3 years,
Right.
4 years. So we just feel like where we're at today and where we've come over the last 15 years with 08, 09, COVID, the tech bubble burst, active manage is important. So we have these calculation points, right, that Helios and our partners do. And so we're really overseeing these, our portfolios twice a month.
Twice a month, right. Yeah, and even if there aren't changes twice a month, what we're saying is, do you still need to rebalance back to the weighting?
Right.
Right. So you didn't make any changes, but your portfolio is a little out of balance. We're still making and rebalancing portfolios to that exact target to, again, sell high and buy low.
So if the current model is 55% stock equity and 45%, if you're out, it'll go back to that.
Correct.
And then you mentioned this range, this dial that we can actually dial back risk.
Correct.
And one of the things that, we want to just continue to talk about is, institutional investing. So the big boys, they focus on long-term compound returns. That's what they focus on. Long-term compound returns means 10 years, 15 years. And so they want to make money when you can make money.
Correct.
But they also focus on how much you don't lose.
Correct.
And so making sure that we protect that from that standpoint is important. So another question we have, I think that's appropriate here, is, and we can dive into this really, really deep, but how do the data and do you calculate different data from different, so why don't we just talk about elements real quick and how things are calculated? Because it does get very, very analytical. So let's just chat about that.
I think the elements are really just going to be primarily on the factors of things that can be calculated.
Yeah.
Right. But it's always going to be things regarding, what the economy looks like, what earnings look like. There's momentum in stocks. There's going to be inflationary points. There's jobs reports. There's all those different data points. So everything when it comes to an element is getting assigned something, and for the, what they would determine as the best risk-adjusted return. And as those adjust, we're, of course, moving accordingly, whether that's maintaining the same stock range. So you could have a 50% weighting to stock, but what kind of stock are you owning in there could adjust, whether it be large cap growth, or now we're picking up small cap values, or we could be picking up France, we could be picking up more technology or healthcare. Those elements, those components that going in are really helping us decide what to own, why to own it, and when to own it.
Yeah, and I think, and if you want to dig in deeper with your advisor, we've got white papers on every one of those elements that goes really deep.
Right.
So if you really want to get deep and read into it, we have that information available, and it is thousands of data points.
Oh yeah.
And the data is not always right? But it's based on data and facts. So the other thing we wanted to share here, we'll refer back to the screen, is, what have we done? So if we just kind of pick at the screen and you look at moderate, back in December, you can see that our moderate models, blended models, was at a 65% stock, 35% bond. And so if you're thinking, well, what has it done? We have de-risked some.
Yeah, we've definitely de-risked. And again, what this doesn't show you is what are the asset classes within that equity. But
Like more large cap versus small cap, less small cap.
correct. So for example, we just added back small caps. We removed small caps in the November era time frame, and small caps just got hammered over the course of 2 months. Well, now the data says it's a good buying opportunity, a good place to put some risk on, and so we added those back, and they've been the best performing equity asset class in the last month. So again, is it win every time? No, but does the data support that over long-term compounding it works? 100%. And so we are actively managing, so it's not always just a simple stock bond percentage. Sometimes it is, and in this case it's been a stock bond percentage, but it's when do I own emerging markets or when do I own large cap growth versus mid cap value.
So I think, for those obviously clients, a lot of clients watch this, they know it's being actively managed based on data, facts and so forth. If they're not a client and they haven't heard from whoever they're working with and making changes, there may be changes warranted.
Very much
that
so.
are not being done, because the just hold on and just let it get through it is, we don't think is really kind of in the long-term best interest of the portfolio.
Correct.
So it's really, really important there. Yeah. So any other thoughts as people are thinking about, we do get that question of should I de-risk? Well, you mentioned the 30%, we can dial it back. And so any other thoughts about that?
I think the main thing is let's not get too concerned about short-term volatility. We haven't really seen downward pressure in equity markets since March of 2020, and obviously that was a nice recovery, a very quick recovery, robust. But before that, you really didn't see too much downward pressure in equity markets until the 08-09 era. So sometimes it's just very uncomfortable. 2 months in a row of downward pressure, we're not used to it. So I would say we've seen it before. We might not remember, but we've seen this stuff before. Let the math do the work for you. We're actively making changes. Trust the process; it works, and really just keep an eye on it. And if you have questions, make sure to ask them.
Yeah, make sure to ask us as far as working through. The other thing we're going to do, and you've probably seen this, with what we have today, is we're going to communicate, more often than what we do. So we're going to communicate, after the first of the month. So calculations are done. We meet with Helios, review that data, and make a decision as a committee. And we do have all decisions still. We can make those decisions as a committee. And those changes are made fairly immediate. So when they're made, at the first of the, day one of the month, we get those changes in by the end of that day. But we're going to communicate more. So one of the things we wanted to do as a committee is, whether that's more communication through email. We don't want to load up your email,
right?
But we want to give you more information,
yep.
Right? And you may see some upcoming webinars and stuff. So would like to have you jump on that or watch the recorded side of it. And so we're going to communicate more over this period of time. No one wants more emails, but this is a time for kind of, to do that as well. So, so Matt, any kind of closing thoughts for our audience out there?
No, I don't really have anything. Thank you, obviously, for the continued business. That's always appreciated.
Exactly.
And
Thanks
the trust.
exactly. These are times like this where, I think we play a big role in helping people just get through it,
Yep.
And especially a lot of people that are transitioning.
Correct.
I know we have a lot of clients this year that are retiring, and so that's a big step for people. And Matt and I, we haven't retired. We're here. We're going to be here for a while, but we've retired a lot because we've helped a lot of clients retire, and so has the other advisors on the team. So, we're here for you. And it's also this time, you got taxes and thinking about it. So that's a busy time getting your taxes done. And, we're really kind of that comprehensive firm. So, once you get through tax season and we get through kind of this first quarter or maybe the first couple of quarters, as Matt said, we think our outlook is that, fairly positive still. And we'll let the models kind of work through it, right?
Exactly.
We'll let the models work through it. The other thing that I wanted to mention in closing, I want to make sure that you visit, if you haven't, and you log on to hilltopwealthtax.com. take a look around the website. So we've done some enhancements to the website, more information. We have guides and checklists on there. There's some upcoming events, so we're looking forward to that, right? Getting back to some other events that we really haven't been able to do much over the last 2 years or so. So take a look at the website, and there's more information on that. And as always, as we're working through all this, if you reach out to your advisor, and we'd be glad to answer questions. If you're new to Hilltop and you're just running across this, or we've had conversations in the past, we would be glad to take a 30-minute introductory call so that we can, introduce ourselves, find out more about you, and really there's no obligation there. So I'm going to close it out, Matt. I think we've covered it all. Again, we want to thank you for watching this today. Hopefully spring's here in northern Indiana, and hopefully we'll see everybody or talk to you soon. Matt, again, thanks for joining me today.
Pleasure as always.
All right, till next time, everyone, I hope you have a great day.